Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insight. I hope that you guys are recharged and have a good restful weekend as we head into this rather volatile week. So very good morning to all. I'm Kelvin here. Today will be 16th of June 2025, Monday. So before we kickstart our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into today's very interesting intraday technical outlook on those major cross asset classes that we cover on the daily basis, the major US dollar pair, the major stock indices, and as well as the two key commodities market, which is most market participants are watching very closely now, gold XAU/USD, and as well as the West Texas crude oil. Let's have a recap what has taken shape on Friday over the weekend, and as well as in today's early Asia session before we kickstart our daily dose today at 11 a.m. Singapore time. So primary concern over at last Friday is not pertaining more on economic data. It's rather this particular geopolitical risk tension increased news flow pertaining to Israel and Iran retaliation strikes against one another. So on Friday, Israel kind of did a shock, we call it airstrike on Israel on Iran key installation, and as well as managed to actually take out Iranian key military leadership, a couple of them, and this ongoing strikes between this, I would say, this ongoing conflict between these two key players or stakeholder in the Middle East doesn't seem to show signs of abating. So what we could see over here is that on Friday, we do have across the board sell-off in the major US stock indices, the Dow Jones, the Russell, even the Nasdaq 100, S&P, all four of them, and as well as the Dow Jones, all of them close in the red and have more than 1% fall over here. So if you look at the S&P heat map at this point in time, that was last Friday performance. So last Friday performance, we see a slew of red over here, and the worst hit were the mega cap technology stocks, where they are pretty much of a high beta and momentum play. So any negative feedback loop that is not really priced in fully by the markets, especially due to rising geopolitical risk premium, the worst hit will be this high flying momentum play mega cap technology stocks. So we see semiconductor, within semiconductor, the biggest we call it momentum team play among the mega cap technology stock is Nvidia, which is performed far worse than the benchmark indices, which is down by -2% on Friday. And also the worst hit were a couple of the financial banks as well, because banks, they are rather cyclical in nature. That means if we start to see persistence geopolitical risk tension rising in the Middle East, that could actually spike oil prices globally, and that could have a double whammy impact in the US economic growth, given the fact that US President Trump policy at this point in time doesn't really create a positive stimulus to the US economic growth, at least in the near term. Number one, you have this erratic we call it uncertainty pertaining to how the US White House administration wants to implement its slew of rather complicating basket of different tier of tariffs, trade tariffs against the rest of the world. And also on the other hand, we have this potential widening budget deficit in the US, and that could be much widened further if US President Trump aggressive we call it a tax cuts bill is being passed in Congress, and that could also potentially see a stagflation risk rising. And the only sector that is benefiting from last Friday rise in geopolitical risk premium due to the Israel-Iran conflict that is may persist for at least a week or so, given that there is no signs of both sides are talking down any deal. Oil stocks benefited, okay, where we see ExxonMobil with the likes of EOG all rallying by more than 2%. So if you look at the sector heat map over here, right, so we have the 1 week performance. We start to see a big jump in oil price, right? So energy, a big jump in energy sector among the S&P 500. So I'm talking about this, the US stock market rallying by 5.67%. The defensive also benefited last week, healthcare plus 1%. The utilities also a defensive play up by 0.6%, whilst you start to see the cyclical sensitive financial, industrial all underperform, and even the technology stocks or sector is only down margin, also underperform marginally by negative 0.16%. So later I'll cover the short-term intraday technical outlook on the major US stock indices. What are the latest short-term trend bias and key levels to watch out for? And over here, what we could see is that the another benefit from this risk off event that is being seen on last Friday is gold price. So gold price, if I go to the, where's the gold price over here? So gold price actually rallied up by 1.37%, and it managed to clear above 3,435, which was the previous medium-term swing high of 6th of May. All right, so for gold, we have been pretty much have a bullish bias on the intraday basis since last week. So those who followed my daily dose of market insights, I do keep on mentioning that whatever pullback in gold is more like a minor corrective decline within a short-term and medium-term uptrend phase that is still intact over here. All right, so next up will be the first resistance to watch will be the all-time high area at 3,005. So what after 3,005? Later I'll share with you all using the short-term for that short-term intraday technical outlook when I cover in gold price over here. And for sure, WTI crude oil price actually rallied on last Friday. So if you look at the West Texas crude oil prices, it actually up on a daily basis 6%. Okay, it rallied by 6%, and in today's Asia session initially it was up by around 1%, and now it actually trended downwards at 0.63%. So later I will share with you all, is this we call it current pullback in the West Texas oil may lead to a potential bearish reversal over here, whether yes, last Friday push up in oil price, is it a fake head move, that means a failure bullish breakout? I'll cover much more later in my short-term intraday technical outlook when I cover in the West Texas oil. All right, and also up early this morning, over the weekend over here, Trump said that US could potentially get involved in the Iran-Israel conflict. So that means he actually gave a signal that there could be potential military involvement in this conflict between Iran and Israel, causing the geopolitical risk premium to rise even further if there is more clarity that US may get involved, or Iran starts to actually attack US interests in the Middle East. Right, so things are pretty much fluid at this juncture. And one thing I want to highlight that over the FX market, now back to the FX market over here. So what I could see the FX market very interestingly is that, you know, traditionally when there's a rise in this geopolitical risk premium or risk tension in the Middle East, the dollar will tends to actually rally very fast, rally up very significantly. But at this time round, yes, there was a sharp up move in the US dollar over here. You can look at my cursor on my screen. Oops, sorry. Let me expand it. Yeah, so this is a 5-day rolling performance of the US dollar against the major currency as of today. So this, you look at my cursor, this was Friday early Asia session time. So once there's this news release stating that Israel has struck Iran on early Asia session, there was a spike in the dollar across the board. So after this spike in dollar across the board that lasted for only about 2 hours in the Asia session. So around Friday 12:20 p.m. Singapore time, the spike in the US dollars, the rally in the US dollar starts to temper off, and the dollar just trades sideways against the rest of the other major currency. So if you look at the 1-day rolling performance, it's much pretty clear that it's hovering in the sideways trend at this point in time. So what we could see is that means, i.e., potentially there could be a lot of different directional bias in the very short intraday term among the major dollar pair. Later I'll cover on, I will touch on later in my intraday technical outlook. And also very quickly, let me go through the dollar index. So what you could see over here is that the dollar index, despite last Friday push up over here, it can't break above the previous day swing low taken down earlier on Thursday. Now turns into a short-term or near-term intraday pullback resistance at this 98.55. And also up next over here is that we also have that 20-day moving average right above it at 99.25 over here. All right, so pretty much indicating that the short term, the short and medium term trend of the US dollar index is still more on the bearish side of the story rather than the bullish side of the story. And even the daily RSI on the US dollar index is not showing signs of any bullish divergence, as price action continues to see a series of lower high over here, and it hasn't even dipped into the oversold region yet at this juncture. All right, so later I'll touch on more on the short-term outlook on the euro dollar, the sterling dollar, the dollar yen, and the Aussie dollar. All right, and what we could see now in today's Asia session, there is some form of, we call it a rally in the major Asian stock indices, and as well as the E-mini on the Nasdaq 100 and the E-mini futures on the Nasdaq 100 and S&P 500. So the S&P 500 E-mini futures is up by 1% now. The Nasdaq 100 E-mini futures is up by 1.3%, and the Nikkei is up by 0.95%. And the Hang Seng indices is almost unchanged. The Hang Seng index is down by slightly negative 0.09%, whereas the Hang Seng Tech is up by 0.35%. So what's the reason that the Asian stock market is so much more less bearish in today's Asia session, followed by a brief rally that's being seen on the S&P and Nasdaq 100 E-mini futures right now as we are speaking, because we do have some positive data out from China. So over in China, market participant is pretty much concerned about deflationary risks that could spread out throughout the rest of the world. And what we could see is that the housing price index that has been in the doldrums for about 2 years, the rate of decline has started to slow down. So previously, it was negative 4% for the month of April. Trading Economics forecast to be deepened at negative 4.3%, but surprisingly, it came in better than expected at negative 3.5%. So you look at the trend of this housing price index in China, the rate of, you look at the 10-year trend, okay, but the rate of decline has started to slow down since December last year. All right, it starts to slow down over here. So that's actually an encouraging sign that the deflation risk may start to get abated or negated in the Chinese economy. And one more other key metrics in the Chinese economy is retail sales. So retail sales represent consumer spending. So we know that deflation risk has been pretty much in the mindset of China and business consumer, and leading them to lackluster sentiment, and in the end also depressed retail sales figure. So retail sales figure came in way better than expected. So market is expecting only 5% increase year on year for the month of April, even down slightly from the previous month of market is expecting 5% year on year for the month of May, down slightly from 5.5% 5.1% year on year in April, pardon me, but it came in way better than expected at 6.4%. So if you look at the retail sales figure over here, okay, it's showing signs of recovery over here. That means you start to see a series of higher high and higher low since November 2024. Right, there's some signs of recovery at this juncture. So you look at the 3-year trend, right, much more clearer. A series of higher high, higher low seems to be potentially forming a base of turning around. So that's encouraging. We call it economic data out from the China, because especially these are tier one economic data. So one data to bear in mind is the industrial production. So industrial production has a tendency to have a direct correlation with export growth. So we know that China has been pretty much hard hit by US tariffs, and also the ongoing tension between US and China may not been 100% confirmed that it will go back to prior to the state before Trump second presidency, means before US President Trump unleashed a series of higher reciprocal trade tariffs on China in April, and where we know that last week's these two superpowers nation managed to actually have a defrost in their hostility, having that 90 days pause where both sides try to work out a deal, but things could change, and the industrial production figure represent that over here with the uh, slowdown in industrial production. We also represent a slowdown in its export growth coming out from China. So previously it was at 6.1%, market expecting a slight dip to 5.9% for the month of May, and it came down slightly worse than expected to 5.8% year on year. So if you look at the industrial production trend of China, all right, for 2 consecutive months, it starts to slow down after that sharp push up of 7.7% year on year in March. So this more potentially could be due to front loading over here. So if you look at the trend, the 10-year trend, right, it starts to, that growth starts to slow down over here. So I would say that overall, one rather lackluster economic data out from China, but two of them came in better than expected, which is house price index, and as well as retail sales. So the net effect overall has a kind of a positive feedback loop into the Asia major stock indices, and as well as has some form of a positive reaction as well on the S&P 500 E-mini futures and the Nasdaq 100 E-mini futures right now as we are speaking, at both of them are up by 1% on the S&P E-mini futures, and the Nasdaq E-mini futures up by 1.28% as we are speaking. All right, so and also before we jump straight into the intraday technical outlook, I'm going to share with you all, despite that rising geopolitical risk premium in the Middle East right now, the expectation for this week or this Wednesday FOMC meeting. So this week will be pretty key. We have the FOMC meeting, which is the US Central Bank Fed monetary policy decision. Markets still don't expect the Fed to move to even cut rates, despite that geopolitical risk premium could put a dent on US economic growth. If you look at the interest rate futures, so basically the CME Fed Watch 2 is based on it's a calculation done by CME. The calculation is based on the latest pricing from the various months Fed funds futures contracts. So basically looking at the mindset of the traders in the Fed funds futures contract. So market is still expecting the Fed funds futures market is still expecting a high chance of 97% that the Fed on this coming Wednesday, that means Thursday, early Singapore time, 2 a.m., to maintain its target rate at 4.25% to 4.5%. So Fed has been not cutting any interest rates since the start of this year. All right. So if you look at the movement from 1 day ago was at 99%. So right now it's 97%. So there's no major changes in terms of expectation. And if you look at from the aggregated basis over here, that means looking at the various possibility of the Fed funds futures market expectation on the various monetary policy meeting down the road. So if you look at the July meeting after this Thursday or this Wednesday, market is still assigning a high chance that the Fed will remain stamped as well in July, 80%. Only a small chance of 20% that they may cut by 25 basis points to reduce it to the Fed funds rate to 4% to 4.25%. And only the next cut will potentially come. Oh, sorry, the next cut will potentially come in September, right? 17th of September, high chance of 82.5% to bring it down to 4% to 4.25%. And the next cut, which is pretty high at 95%, it will come in the last meeting of 2025 on the 10th of December FOMC meeting to bring it down to 3.75% to 4%. So the pricing pendulum still remains unchanged. So market is still expecting only potentially two interest rate cut of 25 basis point each. So the reason why over here is that despite this geopolitical risk premium that is taking shape right now in the Middle East, and there's no showing signs of it slowing down, that could slow US economic growth and global growth as well. But however, there's also a risk of stagflation. So if US Federal Reserve were to cut interest rate only looking at the growth side of the story, it may reignite inflation pressure in the US, triggered on by now geopolitical risk premium, because that will lead to a rise in oil prices to $90 to or the $100 per barrel, and as well as potentially this US White House administration way of erratic way of implementing its various array of trade tariffs, we call it rates, across their major trading partners, that could also further rises the cost of goods in US as well. Another double whammy of inflationary pressures seeping back into the US economy. So that's why the Fed hands are pretty much tied over here. Once we have that stagflation risk environment rearing back heads to the US economy, preventing them to ignite aggressive rate cuts to negate off the weak economic negative feedback loop back into the US economy due to this rising geopolitical risk tension. Right, so that potentially sum up today's first segment of today's daily dose. Now let me now move on to the second segment, which is the short-term intraday technical outlook on the various cross asset classes. So with that, let me expand my screen. Right, over here. So let's start with the FX market first. All right. So the FX market, let me put it over here. Good. So let's start with the euro dollar. Right. So the euro dollar came down on Friday, hit our first support before rebounding, come break above our first resistance that we highlighted previously, 115.65, before shaping a pullback in the entire US session last Friday, and also going nowhere in today's Asia session, down slightly by negative 0.19%. So still no change because it didn't break above the 115.65 level over at the US session last Friday. So I do not want to tighten my short-term pivotal resistance, short support level, pardon me. I don't want to tighten my short-term pivotal support level to be so tight at 1490. I'll still remains the same at 1440. So using 11440 over here as my short-term pivotal support level. So we will still maintain our intraday trend bullish bias on the euro dollar above 115.65. May see the next resistance coming in at 11660/11690, which is a confluence of Fibo extension level over here. Only a hourly push down and a bearish breakdown for hourly close below 114.40 short-term pivotal support that would invalidate today's intraday trend bullish bias to see another round of minor corrective pullback, retesting 113.60, which is the minor swing low area of 4th of June, and as well as the lower limit of this minor ascending channel that is in place since 12th of May. So that's for the euro dollar. The sterling dollar also same thing, hit the first resistance, come breakout, and it shaped that pullback. And right now it's back again close to the 20-day moving average, the rising 20-day moving average, which is so our short-term pivotal support level at around 135.30. So we're having a slightly lower buffer, 135.30/135.10 for today, the short-term pivotal support level. We also confluence with the rising 20-day moving average. So watching this zone here, 135.30/35.10, short-term pivotal support zone to maintain our intraday trend bullish bias or recovery. First resistance to watch out for will be 135.90. Above 135.90 may expose 136.40 next on the intraday basis. Only an hourly close below 135.10 in a bearish breakdown below it will invalidate today's intraday trend bullish bias to kickstart another round of minor choppy corrective decline to retest the minor swing low of last Thursday and last Wednesday, where it managed to kickstart that minor V-shaped recovery, which is acting as a next near-term support level at 134.70/134.50. Only a breakdown below 134.50 may see a deeper corrective pullback towards the next near-term support zone at 134.15/134 psychological fever, which psychological level, which confluence with the 29th of May minor swing low and the 23rd of May and 21st of May minor swing low area. Okay, so that's for the sterling dollar. Okay, onward next will be the Aussie dollar. So the Aussie dollar continues to rather remain lackluster after it can't break out above this complex range configuration, upper limit at 65.37/65.45. So if you look at the daily chart of the Aussie dollar, ever since around this April, late April of 22nd of April, it has been trading in this rather complex range configuration. All right. So ever since the last start of this month, it tested a couple of times, in fact, more than 3 times or 4 times at that 65.30. It can't have a proper breakthrough before inching back down to the middle part of this complex sideways range configuration that is in place since 22nd of April this year. So if you look at the short-term intraday outlook on the Aussie dollar, it seems to us that the hourly RSI right now is continues to trade in a series of lower high over here, and right now it has broken below the previous higher low. So there's a kind of a momentum bearish breakdown over here, you could see, and it takes shape right below the 50 level mark, hasn't hit the oversold region yet. So indicating that on the intraday basis, there could be still some form of residual bearish momentum that is still intact that could push it down further towards the lower limit of this complex sideways range configuration. So with that, what I could do is the first support resistance level to watch out for today will be this level here at 65 figure level, which is also very close to today's Asia session intraday high at the moment as we are speaking. But I don't want to put it so tight at 65 figure level because it hasn't broken down below last Friday minor swing low, where on Thursday before I went for a break, we do still have a bearish bias. So first support has been met on that bearish bias on last Thursday, but it hasn't broken down below it. So I do not want to tighten my short-term pivotal resistance to be so tight at today's intraday Asia session high, which is at the 65 figure level. So I'll be still using the key resistance level of this sideways range configuration, which is the range resistance, pardon me, at 65.37/65.45. Still maintain my intraday bearish bias for it within a complex sideways range configuration of the Aussie dollar for it to drift down towards the lower part of this sideways range. A breakdown below 64.55 may expose the next near-term support level at 64.07, which confluence with the rising 50-day moving average as well. Only a hourly close and a bullish breakout above 65.45 that would invalidate today's intraday bearish bias to see a squeeze up to retest or to expose the first intermediate resistance, or to see a bullish breakout, I would say, for 65.80 to come in next in the first instance on the intraday basis. That also confluence with the congestion area of 12th of November and 13th of November last year. So that's for the Aussie dollar. All right. So next up will be the dollar yen. Okay, so the dollar yen was rather sideways. So we do have a bearish bias on last Thursday. It hit our support at 41.43 figure on Friday before it staged a bounce, and right now it's actually the rebound managed to stall at the short-term resistance level that we highlighted on last Thursday before I go for my break. Due to my medical appointment on Friday at 144.70. So still no change, still using the 144.70 as my short-term pivotal resistance for today. Still maintaining that intraday bearish bias on the dollar yen for it to potentially drift back down to this minor sideways range configuration over here. So you could see that it's in a minor sideways range configuration since the low of 3rd of June, the start of 3rd of June, which is start of this month. So first support level to watch, or the downside trigger level, will be 143.90. So that is indeed Asia session low 143.90. A breakdown below 143.90 may expose 143.50 and potentially revisit last Friday minor V-shaped low on last Friday at 143 figure level. Only a bullish breakout and an hourly close above 144.70 may see it squeezing up towards the top of the range at 145.35. Above 145.35, 145.35 sees the range resistance at 146.10. So bear in mind that the dollar yen doesn't seem to have a clear trend right now. So since hitting this low of 27th of May and 3rd of June at the 142.35 level, it starts to trade in this kind of complex sideways range configuration. All right, so that's for the dollar yen. Still using 144.70 as my short-term pivotal resistance level to maintain our trend intraday bearish bias within this complex sideways range configuration for the dollar yen. All right, so that's round up the intraday technical outlook on the major dollar pair. So now let us now focus our attention to the major stock indices, starting with the Hong Kong 33, which representing the Hang Seng Index. So Hang Seng Index on last Thursday, we do have a bearish bias. So we're looking for it to come close to the 20-day moving average, which is a rising 20-day moving average at the 23,440 level over here. So no, 23,600, 23,440. Okay, so it's zone over here. And what's interesting over here is that upon hitting the 23,600, 23,440 support level that we have on the last Thursday bearish bias for that corrective decline extension scenario, the hourly RSI shaped a bullish divergence. Okay, so what you could see over here, he hit the oversold level, and after that there was a bullish divergence on last Friday US session, indicating that that extension of that minor corrective decline from last Thursday all the way down to last Friday more or less is over because of this bullish divergence that's being displayed on the hourly RSI, indicating that right now the short-term intraday bulls may have a firmer grip on the Hong Kong 33 index at this point in time, and also supported by that more better than expected key Chinese data that came in today's Asia session before the start of our daily dose at 11 a.m., which I highlighted earlier. The data earlier in my first segment of today's daily dose. So with that, we will flip back, pardon me, to an intraday trend bullish bias again on the Hong Kong 33, using 23,600/440 as my short-term pivotal support zone. First resistance zone to surpass, to watch out for, will be the gap resistance over here that gap down on last Friday, 24,010/24,200. Above it, may see the next resistance coming in at 24,490. Only a bearish breakdown and an hourly close below 23,440 that will invalidate today's intraday trend bullish bias on the Hong Kong 33 to trigger off another round of corrective decline sequence, extending it for it to go further, exposing the next near-term support level at 23,060. Below 23,060 may see a retest on 2nd of June minor swing low area, and also conferencing with the 50-day moving average, acting as the same support level at 22,700. All right, so using 23,600/23,440 short-term pivotal support on the Hong Kong 33 in order to maintain today's intraday trend bullish bias stance. Next up will be the Japan 225 representing the Nikkei 225. So the Japan 225 and Nikkei 225 last Thursday, we also have a bearish bias. He hit our support level at 37,680 before bouncing up again. So right now it's managed to reintegrate above the 20-day moving average, where it bounced off the 20-day moving average. And what you could see over here is that since the high of 13th of May, it seems to me now that the Japan 225, at least on a very short-term basis, on the hourly time frame, is now involved in this kind of ascending range ascending triangle range configuration, all right, where we start to see a series of higher high but similar high, all right, similar series of higher low but similar high, all right, that can't break above the minor swing high of 13th of May. So right now, last Friday, it managed to hit the lower limit of this symmetrical triangle range configuration and bounce off the 20-day moving average. So on today's intraday focus, I will flip to a intraday bullish bias, but this bullish bias is only within the range of this potential ongoing minor ascending triangle range configuration that is still unfolding based on the Elliott wave perspective. We would flip to a bullish bias using the short-term pivotal support, which is the lower limit of this symmetrical triangle range configuration, lower limit of the ascending triangle range configuration, pardon me, about time twisting, and also confluence with the 20-day moving average at 37,680. Only resistance to look out for will be the top of the range at 38,850 over here. Only a bearish breakdown below 37,680 will see another round of choppy corrective decline sequence unfolding again on the Japan 225, exposing the next near-term support level at 37,270 that managed to survive since last Monday, 2nd of June. A breakdown below 37,270 may see a deeper corrective pullback to revisit the 23rd of May minus swing low and the 8th of May minus swing low that is confluencing with the rising 50-day moving average at the same next near-term support level at 36,560. Next up will be the Germany 30 representing the German DAX. So we do have a bearish bias on Germany 30 late last week because of the very weak price action configuration and the bearish reaction of the 20-day moving average on Wednesday. So with that over here is that there was a gap down on Friday. Price action seems to be now consolidating within a kind of a bearish pennant configuration over here. So with that, I would use the gap down or the gap resistance at 33,675. So that will be my pivotal resistance for today. We will flip to a intraday because we will maintain our intraday trend bearish bias for the next support level to come in at 23,150, which is the minor swing low of 8th of May. A breakdown below 23,150 sees the important minor swing low of 6th of May confluencing with the same 50-day moving a rising 50-day moving average, same support level at 22,910. Only a bullish breakout and hourly close above 23,675 that would invalidate today's intraday trend bearish bias on the Germany 30 to see at least some form of minor recovery in first step to revisit the 20-day moving average at 23,880 slash 24,025. So it's a zone, a resistance zone over here. Only a breakout above 24,025 may see a much more confirmed recovery scenario towards 24,240 next in the first step. So that's for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 on Friday, on Thursday, we do have a bullish bias using 42,580 as my short-term pivotal support. And this short-term pivotal support gives way, breakdown, retest again on Friday during the start of the US session, can't maintain its recovery or momentum and break down, and where it broke below the 20-day moving average as well. So there is actually some form of bearish reaction of the 200-day moving average and the 20-day moving average. So with that, the first resistance level to watch will be close to the 20-day moving average at 42,310, which is also this bearish breakdown trigger point. Previously was a minor resistance, minor support level from 5th of June, supported on the Friday Asia session, but can't maintain and broke down during the US session over here. So with that, that will be my first resistance level to watch. Key short-term pivotal resistance will be at 42,580, which is also confluence with the 200-day moving average. So as long as any bounce didn't surpass above 42,580 for today, that's the maximum limit of the bounce that I could allow. We will flip to a intraday trend bearish bias on the US Wall Street 30, representing the Dow Jones Industrial Average. Near-term support level to watch in first step will be 41,850 for today. A breakdown below it may expose 41,530 next, which is the minor swing low of 26th of May over here. All right, only hourly push up and a bullish breakout and hourly close above 42,580 that would invalidate today's intraday trend bearish bias to revert the condition back to the boost to revisit 43,085, which was the minor swing high of last Wednesday and last Thursday. Next up will be the US SPX 500 or the S&P 500. So the S&P 500 also broken down as well from our Titan short-term pivotal support level previously that we have at around 5,980 level. Push up, then there's a bearish reaction of the former medium-term or medium-term ascending channel support now turns into a pullback resistance level. All right, so I'll be using this level here, the swing high area of 11th of June and 13th of June, where the bulls can push up further, and also confluence with the pullback resistance of that former medium-term ascending channel from 24th of April low. So 6,050 will be my short-term pivotal resistance level on the US SPX 500. First support level to watch for sure will be the 5,940, where it survived the 20-day, where there was a bounce at the 20-day moving average, and this bounce also takes shape in early Asia session as well. A breakdown below 5940 will be considered as the downside trigger level to expose the next near-term support level at 5,850 next. Hit 5,850 next year. Only a bullish breakout and an hourly close above 60.50 that would invalidate today's intraday trend bearish bias. Okay, a breakout above 6,050, pardon me, that would invalidate today's intraday trend bearish bias to kickstart another round of impulsive upmove sequence where the bulls may have control again, exposing the next near-term resistance level at 6,093 next, which is a Fibo extension level, and the 6,093 also the former minor congestion area of 21st of February and 21st of February and 14th of February over here. Okay, so up next will be the Nasdaq 100. So the Nasdaq 100 also shaped that bearish breakdown below our Titan short-term pivotal support on last Thursday at around the 21,800 level, where it broke down below a kind of a bearish ascending wedge configuration. And on last Friday, it managed to survive the 20-day moving average, did a bounce. But however, during the US session, it can't maintain that bounce and stage that bearish reaction of the pullback resistance of that former bearish ascending wedge support level at 21,850 mark over here. So with that, I'll be using 21,840, not 850, pardon me, 21,840 as my short-term pivotal resistance level for the Nasdaq 100. We'll be flipping to a bearish trend bias for today on the Nasdaq 100. First support level to watch will be 21,500, considered as a downside trigger level. A breakdown below the 20-day moving average exposes 21,180 / 21,030 next. So that's for the Nasdaq 100. All right, so that's sum up the however, so I need to share the alternative scenario. So however, if we do have a bullish breakout and hourly close above 21,840, that would invalidate today's intraday trend bearish bias on the Nasdaq 100 to revert the we call it the control back to the bulls, revisiting 20,050 above 22,000 above 22,050 exposes the all-time high area at 22,200 / 22,250 next. All right, that sum up the intraday technical outlook on the major stock indices. Let us now focus our attention to the key commodities market, starting with gold XAU / USD. So gold XAU / USD managed to hit our resistance level, which is this minor swing high area of 7th of May and 8th of May at around 3,420, 3,430 level. So right now it's attempting to do a pullback, all right, over here. So with that, I'll be using a rather a tight short-term pivotal support level for today. Tighten it to 34 figure level. So 34 figure level, if we were to do the Fibo retracement of that last impulsive up move sequence up move from from 12th of June, which is last Thursday, that confluence with the 38%. All right. Okay, if I were to do the settings, right, if I were to shift it to my, this is left, okay, shift it to the right. All right, so that is the 38.2%. all right, 34 figure level. So 34 figure level, short-term pivotal, tighten short-term pivotal support level for gold XAU / USD, which is so the former minor swing high of 5th of June. Maintain that intraday trend bullish bias. Next resistance level to watch will be the all-time high area at 3,495, 3,500 in the first step. Only a breakdown with an hourly close below 34 figure level that would negate today's intraday trend bullish bias to see a deeper pullback towards 33.46 / 33.20, which confluence with the rising 20-day moving average. All right, next up will be the West Texas crude oil over here. So looking at the West Texas crude oil, firstly, let me share you on the daily time frame chart first. So we know that there's a strong bullish move on last Friday, which is up by 6% by the close of the US session. So most likely, I would like to know whether this is a failure bullish breakout, like whether this will be a failure bullish breakout like we see earlier on the 15th of Jan this year. So what I could do is that I will actually look at the weekly time frame chart. All right, so this is the daily time frame chart. I will switch it to the weekly time frame chart right now over here. So let me examine, I share the price action pattern. So we know that this dotted red line here is a major descending trend line that previously kept the bulls since 28th of September 2023 in check. All right, so previously there was a failure bullish breakout that took shape on the 15th of January. Then thereafter the price action revert back down towards the descending dotted major descending trend line resistance thereafter. All right, so the price action that on the weekly candle that actually took shape before the failure bullish breakout was a weekly shooting star. Okay, a weekly bearish shooting star over here, what we could see. All right, but however, this time around is a bullish candle, not a shooting star at this point in time. All right, yes, we may see a weekly shooting star right now, but this is only the start of the week. On Monday, the week hasn't ended yet. So on the entire week of last week, from Monday to Friday, we see a very strong bullish candle instead of this kind of bearish weekly shooting star previously that give rise to the failure bullish breakout. So based on last Friday or last week bullish candle, the probability of a failure bullish breakout that took shape previously on the 15th of January seems to be much lower right now. All right, much lower right now based on the weekly candlestick pattern. All right, so with that, now let us now jump straight to the intraday technical outlook on the West Texas oil. So on the intraday outlook on the West Texas oil, last Friday push up over here, it has now consolidated in a kind of a bullish pennant formation, so like a mini symmetrical triangle with the upper limit of the triangle at 75.18, lower limit at 72.56. So I'll be using last Friday low, which is very close to this former major descending trend line resistance previously from September 2023 now turns into a pullback support at 70.60. So 70.60 short-term pivotal support level, flip to a bullish bias, trend bullish bias for today for West Texas Oil, a breakout above the upper limit of this ongoing bullish pennant formation at 75.18 may expose the next near-term resistance level on the intraday basis at 77 figure 76.70, which is so the 3-time FIBO 3.618 FIBO extension from the low of 30th of May, and graphically is also at this congestion area here of 15th of January and 22nd of January this year. All right, only a price action breakdown and hourly close below 70.60 that would invalidate today's intraday trend bullish bias to revisit the 200-day moving average acting as the next near-term support level at 69.15. Only a breakdown below 69.15 may potentially see a highest chance of a failure bullish breakout in first step, exposing the next near-term support zone at 67 figures /6627. All right, so that sum up the intraday technical outlook on all the major cross asset classes. So very quickly before we go, let's take a quick look at the economic calendar. What are the key data to look out for today? So for today, during the European session, there will be rather quiet. And one of the event I will take note over here is the G7 summit that takes shape, that is being held in Canada. So do look out for any potential sidelines press conference pertaining to leaders' view on the ongoing Israel-Iran conflict, and also more importantly, would there be any potential trade deals that could be signed or could be kind of firm up with the trading partners of with US major trading partners like EU and Japan that have this ongoing trade negotiation process with US official. Do take note of that if there's any potential sideline press conference to be held pertaining to the potential outcome of these trade deals with US and their major trading partners. So that's the G7 summit. The second day for today on Monday, but it will only take shape during the start of the US session because it's being held in Canada. And over that, it will be a rather quiet session. So the big focus will still be on that potential ongoing Israel-Iran conflict that has really extended to the 4th day for today. All right, so with that sum up today's Daily Dose of Market Insight. I'm Kelvin here signing off. I wish you all a great day ahead and we shall speak again tomorrow. Thank you.